Hello, and thank you for joining us for today's webinar. I'm Curt Cumming, President of Goodwood Inc., and I'm pleased to welcome you to our Q1 2025 Fixed Income Markets Update. It's been an eventful start of the year for fixed income investors. The bond market has seen some volatility as inflation data, rate expectations, and global trade concerns continue to shape sentiment. In this environment, clarity and active management have never been more crucial. Today, we're fortunate to have Currie, one of our portfolio managers and head of fixed income. Chris will walk you through Goodwood's current thinking on the fixed income landscape, highlight some of the challenges and opportunities we're seeing, and explain our positioning across our mandates, including the Goodwood Milford Fund and our investment-grade bond strategies. He'll touch on central banks' shifting tone, the potential for rate cuts, including why we believe the Bank of Canada could move the policy rate to 2%, and how we've built resilience into our portfolios by emphasizing credit, quality, duration management, and income generation. So with that, I'll turn it over to Chris Currie for a deeper dive into the data, insights, and strategies behind our fixed income positioning for the rest of 2025. Chris, over to you.
Thanks, Curt. Well, you covered off very well what we're going to cover in this seminar. And I do want to mention, though, go a little bit into how we construct resilient portfolios. And we believe that the Goodwood portfolios are, very resilient, and the foundation for resilience for us is diversification. So we have a mix of treasury bonds, provincials, and investment-grade corporate bonds. They're well diversified by different maturity levels and also different credit levels. So we have a mix of credit ratings from all investment grade from BBB to AAA. And the range of maturities, most of our bonds are in the shorter term. 3/4 are in the midterm part of the curve from 3 to 10 year, and almost 20% in the short end of 0 to 2 years. But most importantly, I think, is we have a very high coupon portfolio. We have over 5% bonds, which is a rarity in this low interest rate market. We've got 31% of our bonds fall into that category. In the range of 4 to 5%, over 50% of our bonds fall into that category. So, over 75% of the portfolio is over 4% in yield. So that's very attractive. And we are active managers. We're not tracking or benchmarking to an index. We actively manage to protect investors' capital and generate income. So this slide that we have on the screen really gives you a pictorial breakout of the different credit ratings and also the different maturities. So on the next slide, I'd like to talk about the current environment, which really it changes every day, but there are some little longer term themes that are arising, and one of those is that the key focus of central banks is the potential effect of inflation arising from tariffs. So we had a major speech by Fed Chair Powell last Friday, and he talked about how he expects tariff-induced inflation to start to come to the fore in the second and third quarters of this year. So we have seen inflation forecasts running as high as 3.5% to 4%, over the current 2.6%, 2.5% level. So that's a significant bump up in inflation, and that's one reason why the Fed has stated that they're on hold. They have a dual mandate: maintain a good level of employment, but also to contain inflation and inflation expectations. We've recently seen the bond market go up and down, as you can see from this graph. We had a big sell-off, and then we had a somewhat of a recovery. This is the volatility index, and we haven't seen this level of volatility in quite a long time. Just sort of straight up as a result of the big sell-off. I mean, a week ago, rates, 10-year U.S. 10-year was well below 10%, as we can see on the next page. But, it spiked up to 4.5%, and that got the Treasury and President Trump extremely concerned. And we saw a response from the government in terms of, talking about how they're going to pause tariffs, to try and calm the markets. So clearly the cap on rates is 4.5% on the U.S. Treasury, and they definitely, and they've stated it much. They want to see it below 4%. That's one of their goals. So let's look quickly at the two different economies, Canada and the U.S. So Canada faces, a similar inflation picture to the United States, but and it's expected to get worse. But Canada has the second part of their mandate, unemployment, on the next slide, which is, really the key concern for the Bank of Canada. So I think the Canadian economy is weakening a lot faster than the U.S. And, you can definitely see that from the unemployment rate here. And, and that, the business environment we think is going to get a lot worse. And that you can see that in the survey data. So this is the business barometer, heading south there, the leading indicator, same direction. And then a longer term IVPMI index is flirting with 50, which below 50 on the next slide is seen as contraction level. So, all the indicators are pointing to a weaker Canadian economy, which you can see that's been anticipated by the market, and you can see, the really tremendous drop in rates. So the yellow colored line is December 31, 2024, and the recent yield curve you can see in the purple line. So, looking at the real big move is down in the 1 and 2 year area, just a really big drop in yields. And, Canadian yields are quite low, I've got to say, relative to the US. So, another data point here is housing starts. As we all know, the housing market is in trouble, and we're starting to see more and more of that in the housing data. But turning to the U.S., the U.S. forward-looking estimates are starting to weaken as well. An interesting anomaly that there was a huge amount of gold in the first quarter imported into the United States. Of people want investors and institutions wanting their gold to be held in the United States, as opposed to at the LME or other European institutions. So the Atlanta Fed, adjusted their figures to take out the gold imports, and it's still showing, for the Q1 a negative 1%. So, that's mainly due to tariffs. As we know, U.S. unemployment rate a lot lower than Canada, 4%. The U.S. Fed does not seem to be paying much attention to that. Next slide, we see non-farm payrolls still healthy. I mean, there's a lot of talk that U.S. labor market, is healthy. We're not seeing negative job creation in a recession. We typically see negative 50,000, negative 75,000. Retail sales, this may be front-end loaded as people buy in front of a tariff imposition. And following that, we get to the real heart of the matter, which is inflation. You can see definitely a rise in inflation. The Fed goal is 2% inflation. We're well above that at 2.8. So concern is PCE, another favorite measure of the Fed, same number, 2.8. So, clearly the inflation is a massive concern. Excuse me, and this is the University of Michigan index, which showed a real bump from 3.5% last month up to 4.1% in 5 years out inflation expectation. So 4% inflation, the Fed does not want to see that. So that's why they're not in any hurry to raise rates, and that's what had the bond market spooked, a couple of days ago, that big sell-off that we saw. So here are the U.S. rates, and you can see that they've dropped dramatically as well. So the end of the year is in the purple line, and currently now we're at the yellow line. So big drop, in the same area, the 1 and 2 year. Looking at our interest rate forecast, we're forecasting 2 cuts for both Canada and the U.S., both in the back end of the year. And we think that the inflation story is going to be with the Fed and with the Bank of Canada for the the next couple of months, which is going to keep them on hold. But if tariffs stay at a level that's sub 20%, we would expect to see the economy in both countries, weaken significantly. That would require a response by the Fed and the Bank of Canada to try and stimulate the economy, and that response would be cutting rates. So, U.S. has much further to go. You can see the yellow line is compared to the purple line is the U.S. This was, done this week. Canadian rates, again, as I mentioned before, super low compared to U.S. rates. So, a lot of room for U.S. rates to come down. So, on that note, I'm going to pass it back to Curt.
Thanks, Chris. Good update. Here we're talking about the Goodwood Milford Fund. So this mandate is to invest in opportunities that offer the best risk and reward for their respective capital structure risks. With comparatively low turnover ratio, our approach excels at dynamic active management, adopting to these macroeconomic changes while leveraging Chris's over 30 years of fixed income expertise. With a strong focus on and a history of maximizing returns through higher coupon income and credit enhancing events, the fund has earned 11 industry awards, including Best 5-Year Ratio, Best Canadian Hedge Fund with its 10-year return. The strategy delivers outperformance with low volatility, with superior diversification through a balanced mix of income-producing securities. As previously stated in other webinars, our return expectations combine coupon income and capital gain to reach our 5 to 8% per annum. Goodwood's investment grade bond mandate aims to preserve capital and provide a high rate of cash coupon income by investing in about 25 investment grade fixed income securities, targeting 100 to 150 basis points above the 5 years. And Goodwood's ESG conscious investment grade mandate invests in a portfolio of very liquid securities from issuers that have achieved good relative scores with third-party ESG valuation processes. So here we we're showing the different content that we provide to our investors to inform them and the advisors of what's going on in the fixed income market. This includes same-day commentaries after each Bank of Canada and FOMC meetings. Of course, our monthly commentaries, and we go through the fund's results and the detailed quarterly information that goes into a lot of detail on the actual investment portfolio. And of course, we do these webinars every quarter and on an ad hoc basis when there's a material event in the market. Please let me know if you want to be added to any of these distribution lists, or if you want to get a copy of today's webinar slides. Happy to send that out. You can either reach me or anybody on the Goodwood fixed income team. Thanks so much and have a great day.